All right. Yeah, and I mentioned I'm sitting in Colorado. Farooq is in New York City, and I think we'll go ahead and kick things off. So today we're going to be talking about fund performance metrics to share when it's early. Really excited to have Farooq here from Preface Ventures. So a little bit about Farooq just to kick things off. So Farooq actually started Preface Ventures, the pilot fund, back in 2015 in New York City, and has been investing for 16 years on both sides of the Atlantic. Farooq has invested in over 80 companies in his career, and there's been several IPOs and exits. And he's also the co-founder of Diversity VC. We really like that group and have done some content with them. But if you haven't heard of Diversity VC, it's a nonprofit group made up of all people working in venture capital seeking to increase diversity in thought and venture capital. So if you haven't heard of them before, feel free to check them out. Anything you'd want to add, Farooq, and share with everyone?
No, I think for now is okay.
Okay, sounds good. Yeah, we'll dive into Preface more in just a bit. And then I probably have seen a lot of you before from different fronts, but my name is Belle, and I am leading sales and customer success at Visible. I've been at Visible for about 3 years and really love it. And you can follow us both on LinkedIn or Twitter there if you guys are interested. So diving in just a little bit more and setting context about Preface Ventures. Now I will actually hand it over to you, Farooq. We have some things on the slide here, but tell us a little bit more about Preface Ventures.
Yeah, sure. And thank you again for having me, and hello to everyone. So Preface, the first institutional fund, was founded in 2020. It's a pre-seed and seed fund based in New York City. We have 27 investments across the two funds, and what we would call as a novel enterprise infrastructure. So cybersecurity, developer tooling, healthcare, and fintech, all with a B2B angle. The founder profile that we back is pretty kind of consistent and I think novel. We exclusively back repeat founders who have had a modest outcome, modest to maybe even more than that, and they want to go for a second or third bigger swing the next time. So if you know folks like that, we'd be happy for those in the call. We'd be happy to co-invest. We're flexible. We're currently deploying out of our third fund, the second institutional one. Our first institutional fund was 20 million. The second is 25 million, which is Preface 3. 80% of the time, we're the first check. We often co-invest alongside the founder, he, she, or they. And yeah, I've been a Visible customer since 2021, and I love it. Honestly, people respond really well to the format, and they think highly of Preface by way of Visible. So thank you.
Excellent. Yeah. And I think it is really unique that you guys are specifically seeking out kind of repeat founders, and would just be curious to know what percentage of your founders have had a previous successful exit.
Yeah, 90%. So 90%, like the lowest. All exits are meaningful. But to be back to founder with like a 10 million bootstrapped exit to GitHub, to like a 1.5 billion outcome to Adobe and Delivery Hero. Usually that's sort of like the golden range where people are still hungry and they tend to build a business that's similar in the same category. So when they go the next time, a lot of those learnings translate.
Okay, excellent. Yeah, so if you're on the call and have repeat success founders in your portfolio, now you know kind of what Preface is looking for. And then a little bit about Visible. If you aren't familiar already, so Visible has 2 different platforms, one for founders to help with fundraising and updating investors. And then today we're talking about more around investors. So our investor solution is all about post-investment monitoring and reporting. Visible started in 2015. We've been profitable since 2017, have a wide range of customers, so spanning across 47 countries, and then just have some highlighted investor customers here on the bottom. And you'll see the Preface Ventures logo is included on there. Just a bit of housekeeping before we hop into things. Yeah, go ahead and use the Zoom Q&A format at the bottom. We love it when questions come in from the audience. So yeah, definitely leverage that. We'll have dedicated time at the end to go through questions. But if you are sharing something really relevant at the time, I may kind of go off track a little bit and have Farooq answer the question right there and then. But yeah, feel free to write in there. And the webinar will be recorded, and we usually send it out same day or within, the next day. So just know that you'll receive this via email. And today, what we're going to spend the next 40, 50 minutes going through is we're first going to talk about the challenges of benchmarking a fund when it's early. And then we're going to dive into Preface Ventures Seed Stage Enterprise VC Funding Napkin. If you don't know what that is yet, you're about to learn. And then we'll break down some of the benchmarks that are listed in that napkin. And then we're going to be talking about communicating fund performance to LPs. And we're going to take a look at some LP communication examples from Preface Ventures. All right, so kicking things off, talking about the challenge of benchmarking funds when it's early. This chart here on the right is talking about the percentage of active funds that are shifting in quartiles over time. So Farooq, when you look at this chart, what should be the takeaway for LPs and for fund managers?
Yeah, I mean, I think we should all know our crafts, and I think that we all know that VC is kind of a long game, right? And you don't really know quantitatively what quartile you're going to be in, according to Cambridge Associates, until after year 5. But you can feel good about like the right process and guardrails, which the napkin is eventually about. But yeah, it takes time. I mean, even in year 0 to 1, 1 to 2, 2 to 3. I mean, part of the funds haven't even been deployed yet. So you might have a new investment that could make or break you, hopefully make.
Yeah, and so the rest of the conversation today is kind of going to be talking about like what other benchmarks outside of maybe those traditional fund metrics that people think of, TVPI, IRR, when those aren't really relevant yet, kind of what other metrics can you use to communicate your fund performance, considering within the context that it takes, 6, 7, 8 years to kind of settle into your quartile. So, Farooq, would be curious to better understand kind of what has been your experience facing this challenge with LPs, kind of reporting on fund performance when it's maybe been a little bit too early.
Yeah, sure. So TVPI, DPI, and IRR just aren't that really good of metrics early on. Like during fundraising, again, it could be super misleading because so little has been paid in. And looking even at like this vintage, I mean, the time between rounds is getting longer and longer. Convertible notes have gotten a lot more popular, and that can underweight performance. And even if you have a company that has progressed and has raised money at a higher cap, you can't actually value it as such, or you probably shouldn't. And I mean, I'll give you an example. Even in Fund 2, we have a company that's not far from Colorado in Salt Lake City. It's like a 10 million run rate software business, 5 million of EBITDA, and it's 4xing year over year. And like it's only raised $3 million, and Preface is 2.5 of it, and it's still at a 1x because a price round hasn't happened. And so the kind of experience facing this challenge where, like I tend to find LPs will, it's a boring question or comment, and they'll say like, hey, like where's the DPI after year 3, or they say, hey, this is really early. And I think, quantitatively, and this is a reference point, is that approximately 50% of an LP's returns happens after year 7. And if they don't participate like consistently, like per fund and size checks appropriately, they might actually miss that amazing fund. I mean, if you take a VC's career, let's say 15 years, like 70% of the returns happen in like a 3-year period. Like vintages really, really do matter. And so I noticed, I mean, an easy thing that people like to do is narrative and storytelling. Like, oh, well, I met this company and Bell was the CEO, and, I knew immediately. All these kind of stories I find are like handpicked and repetitive. And I think really sophisticated LPs like want you to have a portfolio approach and focusing on metrics that have high correlation, even with like early data. And I think the early data to focus on is the previous fund, right? So you have your previous fund or something. That's what to look for, and there's correlations here, which we'll dive into.
Yes, I love it. And final question just for this slide. So why is this even more challenging right now, given like the current fundraising climate?
Yes, for sure. I mean, first, a lot of LPs are going towards like private credit and publics, but I think in general in venture, I mean, for people who are even committed to the asset class, in the last 5 years, like valuations have just gone under a lot more scrutiny. I mean, particularly from like multi-asset managers who are LPs and they're looking at VC GPs. And it feels like, you go and you try to explain a valuation to an LP or there are good companies, there might even be companies that are undervalued. And it feels like when folks sort of talk back, it's like fake news, like this is too much, this is too crazy. And look, in transparency, there are like some less good actors or folks that don't have sufficient information rights. I mean, I won't name the person, but like I know someone who kept Clubhouse valued at 4 billion as recent as like 6 months ago when that
Mhm.
company was not worth that much. And as VCs, we don't have like a super strong incentive to keep our books like up to date in real time or sort of accurate. And I think it's challenging, but it's even more important to be transparent, trustworthy, show all the data, and point to the right information that makes an LP comfortable. And
Mhm.
like the point is don't just handpick and focus on specific companies, but get them comfortable with with an investment process and a portfolio level process and fund models and that type of thing. I think that level of comfort is important.
Yeah, no, I think that's really excellent. And I really like that you're speaking to kind of like the portfolio wide benchmarking instead of cherry picking just individual kind of narratives that might be exciting to share with LPs. And so when we look at all these benchmarks in a moment, it's more of a portfolio wide approach. So enter the seed stage enterprise VC Napkin. And this was actually based off of Christoph Jan's SaaS funding napkin, which some of you might be familiar with. If not, I'll actually post this in the chat. I'm a bad multitasker, but I'll get there in just a moment. So I'll post what that is in just a moment. But essentially, Christoph Jan's created this version of a napkin that for startups answers the question, what does it take to raise a round in 2023? So that's the startup perspective. And then Preface Ventures posted about this other perspective. So the GP's view on fund performance and kind of what it takes to raise a fund in 2023. Which I thought was really interesting. Saw this on LinkedIn, and that's when we reached out to Farooq to kind of have this conversation together. So yeah, Farooq, would love to hear from you kind of like what was the motivation behind creating your version of this napkin?
Yeah, of course. So as you noted, like fellow enterprise lover Christoph Jans, who's a great guy, has been a reference for me and for Preface. Investor in Zendesk, Algolia, Revolut, like Chainalysis, really, really good companies. He publishes this sort of napkin that's very like art and sciencey. If you're a seed company or Series A or Series B company, here's the valuation range, here's the kind of team that you need to have. And founders want to know what's good enough annually for their baby, so to speak. And I think GPs and LPs want to know the same for their babies, which is the funds. And fortunately, we were able to raise a larger fund than our last one, which was great. But overall, like there's for sure an imperfect marketplace for LP capital with that, which I think people on this call would appreciate. Who's allocating how much, what's the process, where it goes is suboptimal, and like I've seen this happen firsthand, but mostly secondhand in the 16 years of investing in venture. Like a lot of LP capital goes and gets herded to a few groups that might have like decades long history when actually your most recent sort of fund performance and metrics are way more relevant. And so and when I think about like the LP sort of mindset, particularly when re-underwriting a new fund, I feel like a lot of folks just go off of like gut feel, social pressure, and there is a way to be quantitative, and quantitative is good. It's more intuitive to me stylistically. It makes me feel better, less bullshitty. Excuse my language. And I think our numbers speak for itself like kind of loudest. And even if an LP did want kind of a founder reference, I would be like, oh, well, our net promoter score is 80 plus, and here's how we measure it. So that's just sort of who I am as an investor.
Yeah, I really like it. I think it's a way for LPs to take a more quantitative approach, even if, the fund is early, but also a really impressive way for you as a fund manager to come prepared with this extra data and quantitative approach to be able to kind of kick off that conversation with LPs. So really like the framework. And so where did you get this information to kind of justify the benchmarks that you put together in this napkin?
Yeah, so the information, again, it's generally private and kind of aggregated and anonymized, but comes from Preqin, Cambridge Associates, Coolwater, Sapphire Ventures, Horsley Bridge, Signal Rank, AngelList. Like there's lots of these different sources, and everyone has different kind of quality of data.
Mhm.
But these are folks that have been investing in the asset class for like 30-ish years. And this is what they do, actually. Like several of them have their own version of this to
Mhm.
basically save up time and not get bogged down on all those reference calls. Like, okay, just like show me the numbers.
Mhm.
So yeah.
Okay, excellent. And yeah, and this is the same as if you guys are familiar with that other napkin for founders, it's a mix of like art and science. And the same is true for the one that Preface has put together as well. And so would be curious to know, are you going to create a 2025 version? Are you going to keep creating, different versions in the future of this napkin as time goes on?
Absolutely. And again, like note that it's like for enterprise. I mean, things like cumulative burn multiple and other metrics we'll dive into. Some of these are general for venture in general, whether you're consumer or biotech or enterprise.
Mhm.
But certainly, I mean, I think a graduation rate for a 2020-21 vintage
Mhm.
Series A, it should be above 70%. I mean, I think a lot of people enjoy that, but if you look right now, like this year, it's probably more like 35 or 40%. And so
Mhm.
for average. And so maybe that number is more like 50 to 60. So yes, 100% will publish this annually, and feedback is welcome too. There might be a metric that someone on this call or you guys sort of mentioned as important and critical.
Excellent. Yeah, and then just highlighting again that when we look at these benchmarks in just a moment, it's within the context of year 4 of deployment of a fund. And it can vary, depending on the year of deployment. And then what makes this interesting and why, Christoph, publishes one each year and why you will as well is just like the market conditions and how much those change and how like the definition of what it takes changes from year to year as well.
Mhm.
So, when you were creating this, for an audience, just kind of what was going through the back of your mind? Like, how do you want other GPs to think about this napkin? How can other GPs use this benchmarking?
Yeah, I think actually it's a good idea I mean, it's funny how many messages and emails I got from fellow GPs that said like, hey, like my LP sent me this and like I need to fill it in now. It could be an
Thanks for
accompaniment.
that.
Yeah, yeah. Thanks, man. It
Work.
could be an accompaniment in a DDQ, or like on diligence calls. If someone's asking like, oh, like which downstream investors are you close to, that type of thing? You'd be like, look, like in short, 70% of our companies graduate to Series A, and
Mhm.
60% of them or 80% of those ones are led by a tier one firm, which I define as this, that. That
Mhm.
level of sort of back and forth, I think, creates like a healthy dynamic. But to be honest, like I think GP should use this as more like a self-reflection piece more than
Mhm.
anything. It's hard in venture, like admittedly, right, to know how you're doing, given the kind of feedback cycles are so long. And so
Mhm.
this actually gives me a sense of sanity where I'm like, okay, like I'm doing the right thing.
Yeah, yeah.
Even when my right thing is different from others. So
Mhm.
feel free for those to use it.
Yeah, no, that's great. Self-reflection tool. I think it's again a way to impress LPs if you already have this information ready when they start asking questions or to include it in your DDQ. But ultimately, I think you're raising the bar in venture by publishing this and letting it, other people use this. So
I appreciate
excited to go through it in greater depth. So now we'll actually transition to looking at some of these benchmarks in greater detail. And yeah, we'll start here with this one. So graduation rate from seed to Series A. So it's kind of known high performing VC funds have high follow-on rates to Series A. In your article that you published, some interesting data though around like if a seed VC fund has 50% of the portfolio graduate to Series B, the likelihood of achieving a 3x DPI is over 80%. So really interesting data there. just kind of curious if you want to speak to maybe the actual number benchmarks here, and then how does Preface Ventures actually keep track of this information about your portfolio?
Yeah, for sure. So look, I mean, high performing VC funds have high follow-on rates to Series A's. I generally think like almost half of our job is to make sure our founders are capitalized enough to make like capital efficient, good experimentation and decisions. And
Mhm.
it's, being intellectually honest, like there's all these blog posts about like when a company exits and how the VC sort of like knew from day one. I genuinely think, at least for myself, I don't want to speak for other people, but I can predict 2 rounds ahead. I could be like, okay, do the seed investment. I could see getting to Series B. And then at that point, you don't know. Maybe the market's changed. Maybe there's a regulatory thing. Maybe there's a new competitor. And like increasing the possibility of positive permutations is a good thing. And that happens when you can have good kind of follow-on rates. And so
Mhm.
the metric specifically, when you're referring to the 3x DPI over 80%, again, can attribute to that, but attribute who told me that information from all of their sort of fund of funds data, but
Mhm.
it makes a lot of sense. And so if you think, 70% and excellent graduates to Series A, there's probably some fall off there. Maybe there's an exit, that type of thing. And having about 50% is positive. Yeah, I basically shared this with 5 different kind of fund of funds, and they gave me their anonymized general information, which is good. But again,
Mhm.
consider like in, I don't know, 4 years or 5 years or 3 years or 2 years, these numbers might modify a little bit more, but then
Mhm.
hopefully our ownership might be higher too. Maybe the graduation rate in the future is for excellent is 50%, but then we're able to get better valuations because it's more of a down market. So it does move. How we keep track of this information, it could be invisible. I know that to be true. Right now it's we just capture it in G Suite so far.
Excellent. Yeah, and I just kind of wanted to highlight again, I'm actually looking at your notes that you shared with me, but I love that you shared that like and a very important, and you said like 50% of your job is to make sure that your companies have enough cash to just kind of like withstand the chaotic and unpredictable nature of entrepreneurship. I just really, really like that. Hadn't heard it like said that way before. And we'll come to like a cash multiple benchmark here in a moment, but just wanted to highlight that again. And so when it comes to actually seeing your companies graduate from seed to Series A, how does Preface Ventures help companies with this, or any advice for other funds to kind of be more strategic with how they're helping their companies get from seed to Series A to B in the future?
Yep. First, it's really self-serving. If you're involved in the process from seed to A, you can get pro rata, you can get super pro rata, you can have influence on pricing. We end up introducing, of all the companies that have graduated to Series A, like in the past 5 years, it's probably been like 20 of them. We
Mm-hmm.
have we have introduced the lead 50 or yeah, 15 out of the 20, which is
Mm-hmm.
good. So what do we do is we help them create a target list. We share like a Google sheet together. Firm, contact, next step, like truly like almost like sales oriented.
Mm-hmm.
Have the most beautiful, perfectly forwarded email and
Love
deck. That's
it.
critical. I would encourage folks to like really like time box the process. Like it's sometimes, oh, like we're gonna raise, and then you kind of catch up in a week or 2 weeks, like be on your founder, he, she, or they. I find that if a process takes longer than a month, like you start competing with like the next hot thing, which is critical kind
Mm-hmm.
of competitively. And I think
Mm-hmm.
that the target list formation is maybe the most important. Having someone that we can kind of back channel with, that's the decision maker. And in advance of that, telling the founder, like, don't spend time on fundraising, but maybe there are 3 firms that they stay close to with annually that they catch up with every 4 months or 5 months or 3 months.
Mm-hmm.
We always encourage that.
Okay. Yeah. And when you're giving the advice to time box it, you're not saying like this isn't month one after you invest, but it's like the right time you're sitting down with the company and saying within the month, we're going to have that email drafted for you. You're going to have like your list together. So it's not like right after you close the deal, right? It's like you've decided when the time is right and we're getting this done within the month time frame type thing.
Yes, that's true. But one thing we have in kind of like our preface or like onboarding, like kind of call or email after we make the investment,
Mhm.
we catch up with our founders every 6 to 8 weeks anyway, is we come to a shared view on what's generally enough to raise the next round. And it's
Yes.
good because then you're sharing common language, and then you can, and if your founder is getting distracted, or maybe I don't know, maybe I'm getting hit up by lots of my follow-on investors, like we can ignore it and be like, hey, like we both said, like we want to raise an A when the business isn't necessarily a million of ARR. I think that's too
Mhm.
simplistic. But maybe they have 3 enterprise customers, they have had 5 expansions, they have, customers in 2 continents, or they made this really key hire that was strategic and important. That's important. But no, the time boxing is basically like once someone goes and starts fundraising, like
Mhm.
email everyone in the same week, and then like drive to a conclusion within a month. And
Okay.
conclusion doesn't necessarily mean closing the round, but it means
Mhm.
adding like terms.
Yeah. Yeah. Okay. That makes a lot of sense. And what I also like about that is just like we've done other webinars on, onboarding processes, but just like the importance of setting expectations with your founders, because you and your founders that have then agreed like what point they're going to be at and what point they need to be at to be able to fundraise. So if they come to you and say, hey, where's my intro? Or like, can you introduce me to the next investor? And if they haven't hit kind of those milestones, you can push back and say, not yet, and kind of protect that maybe capital a relationship with your investors in your network as well. So push back a little bit.
I feel like founders give you it's a like people will like listen to you or make decisions at like high points of commercial intent. Commercial
Mm,
and customers too, right? Like you just gave someone like 2 million bucks, they're gonna email you. Like they'll respond if you ask them
yeah,
for, but maybe 8 to 10 months later or 2 years later, it might not happen as much. And so yeah, like I really like your point's super valid. Just set the table at the beginning.
yeah. Um, all right, so let's move on to the next benchmark. So now we're going to talk about pro rata accessibility. So why is this performance metric something a GP would want to share with LPs? Maybe obvious, but maybe how have you used this or communicated this with LPs?
Yes. So, and again, accessibility is the key word. It doesn't necessarily need you don't have to make the decision. But look, most folks on this call, I don't say this is everyone, but probably most folks on this call, like they'll want to raise larger funds eventually, and that comes with
Mhm.
either a bigger entry check and or a reserve strategy or both. And I think the best funds will always have pro rata opportunities, even if they don't take them. Um, so, and like, yeah, I guess your next question, like, what does it say about the GP or the firm? If if you have pro rata or super pro rata, it implies the VC knows their founders and the company, and the founders know them, and they want to continue the relationship. Um, it's critical. So yeah, I mean, like writing kind of a small little baby check, and then like doing, I don't know, a scout check, let's say in a seed round, and then a common question that like some LPs have asked me. They said, hey, like, Sequoia Ledger Series A or Series B, like how much
Mhm.
did you get squeezed down? That's like an assumption or a narrative that they kind of hear and feel. You could actually say like, well, actually, we didn't have contracted pro rata rights, or maybe we did, but we chose
Mhm.
not to. Here's why. Like
Yeah.
all these decision points are a good opportunity to just be better and show up well, particularly if you're correct eventually.
Yeah. Excellent. And then what have you found as like an effective way to increase Preface's likelihood of getting pro rata accessibility with the companies that you've invested in?
One thing that we do, so a lot of founders that we back, again, are repeat. They don't necessarily need a board. So I'd say half the time, or maybe even 75% of the time, I mean, like maybe even the majority, it's a lot of safes. Uh, we have
Mhm.
we have a side letter in which we kind of call out some information rights, which aren't really talked about in safes too much. And then
Mhm.
we have a clause that a founder has to notify us within like 5 days if they get an offer for another safe or a kind of a follow-on round. So basically, being on top is critical. I mean, we do
Yeah.
for founders, right? Like every 6 to 8 weeks, like I mentioned. But maybe the biggest thing is like do the 1 or 2 things that can make a dent in the company, which are in your control or sweet spot. Like can't be a Swiss Army knife. I can't be the person to find your first product marketing management hire and your Series A lead and 6 customers. It could happen, but it's unlikely. Just say what you were going to do and then do it, and then you're good. And again, back to a point we were just mentioning at the beginning, kind of, post at the commercial intent stage, once you've made the investment,
Mm-hmm.
having the intention to actually saying right there, like, hey, we have a desire to follow on, grow, and preserve our ownership according or assuming things go to plan. I don't feel like VCs really say that after the check is sort of done, or even at the, like, it's sort of a casual introductory, like in the introduction, like, oh, we're Preface, we do this, and we follow on occasionally. Being kind of quantitative about it and like being direct is really important.
Yeah. No, I think that's great. And do you have it defined at Preface kind of what your sweet spot is when it comes to supporting companies?
A sweet spot. Customer connectivity and fundraising. I think that's the easiest. I think if you wanted to help with talent, it's like super ad hoc and you might need a talent partner.
Mm-hmm.
But we have 20 C-level execs of public companies who are mostly CIOs and CTOs who are LPs in Preface that we speak with every quarter. And like that kind of connectivity is really, really valuable. Particularly with repeat founders who might actually have a bunch of pilots from their friends that they know and like would give them a little bit of budget. We try to like throw meaner people at them. And maybe not just like Y Combinator, Cloud First CTOs to basically like
Mm-hmm.
make them better.
Yeah, yeah. No, I think that's excellent. And again, we've had people join us for webinars before talking about portfolio support. And instead of just saying like you can do everything under the sun, right, for your companies and you will do everything under the sun, really clarifying what it is you can help with, attracting the type of companies then that actually have that need, but then you can just deliver on what you said you're going to do. And that's so much better for your brand and kind of word of mouth from other founders and things like that. And I do think it's something that Preface does well.
Thank you. It's true in life too, by the way. Like
Yeah,
even
do what you
friendship,
say you're gonna
loves,
do.
relationship. Yeah, just like show up and like do the thing. Don't need to
Be
overtalk.
pliable.
Yeah.
Yeah, yeah, definitely. Good life advice. And then final thing, and then we'll move on here. I've heard you say a few times that you're checking in with your companies every 6 to 8 weeks. Is that like a recurring calendar invite that's just standing? How do you guys actually do that with your portfolio?
Yeah, it's a good. I'm super systematic about it. So basically, I mentioned that right as we're doing like kind of diligence. I will create a recurring calendar invite, but I'll let it expire. So I think like one thing that's tough is you get like kind of calendar traffic.
Yeah.
I'll let it expire like after like 13 events, I think is sort of like the standard.
Mhm.
It's a good thing because then eventually like there's a new shepherd for the round, he, she, or they, and like maybe that relationship kind of modifies and you catch up every 6 months. And then like when the company is doing 80 million or 100 million of annual revenue, it's just like a dinner once a year. But
Yeah.
forcing
Yeah.
that kind of function, and the whole point of it isn't just to sort of preserve pro rata, but even a really well written kind of investor monthly report from a portfolio company,
Mhm.
it'll say like, thanks, asks, that type of stuff, but it won't really give you enough information to be proactively useful and actually have a creative idea. It's mostly
Mhm.
reactive function. So I think being proactive is really, really critical, and that's why we do it.
Yeah, yeah. And a lot of what I'm hearing is Preface does a great job at setting expectations from the start. And there's so many VCs that actually don't do that and are having to kind of like scramble to build a relationship, maybe, deepen it when they need something from the company kind of later on. And there's kind of a related question that came in. So Sean Park asked, curious how you're getting KPIs and financials if you're a smaller fund without info rights. It sounds like you might actually have info rights in your side letter that you're calling out. But yeah, would love for you to answer that question.
That's true in fund 3. In fund 2, we didn't. And so again, through visible, it helps. But basically, like just asking for the 4 or 5 things are the most important. And usually in the first like year or two, it's the CEO that does it. And then there's a little bit of a hand. Let's say if we don't have information rights, there's a little bit of a handoff to like a director of finance or that type of thing, and the responses might get slower. But look, if you're valuable and like you still sort of keep in touch, you should be able to get information. And if the founder, he, she, or they isn't doing it, and there might be a feeling of uncomfort. Maybe they're worried that, their information will spread in a lot of places, and you can just have a frank conversation and say, look, this is just for my LP reporting. It's really meaningful, like for our fund success. And like, I want to know, and I want to know like how I can help you too. And the best way to do that is to know where you're at. I don't think it's a super hard conversation to have, but it's a good question.
Yeah, it is a really good question, a question that we get a lot actually as well. But I heard some things like, side letter, setting expectations early, only asking for what you really need. So 4 to 5 metrics. But if that company knows, like during the onboarding process, right, you just invested, things are top of mind, you're setting expectations for what you're going to ask for every, quarter moving forward. It's going to be way easier to get that information from companies than you scrambling month 14 type thing and haven't checked in with the founder for a while. So thank you for the question there, Sean. So we'll keep moving to the next one. So this next benchmark, cumulative burn multiple. So when Preface is thinking about how you're calculating this, you're actually doing the cumulative. And so just wanted to kind of start by asking, like, why are you considering this as like a cumulative number as opposed to maybe just like last 12 months?
Yeah. I mean, a company that has raised $40 million and like burned 30 in R&D, and like, actually maybe not that, maybe they burned 35 in R&D, and like they have an attractive burn multiple for the year, but burning so much money pre kind of commercial traction, it correlates with dilution. And the good thing about software, it is capital efficient, right? Again, this is a software oriented fund, and like how we back repeat founders is they build quicker, and the R&D window is better, and they can hire people cheaper and friends that they've worked with before. Again, investing in software is kind of like cheating. I mean, like you have like low variable cost per additional user. The working capital cycle of cash should be pretty short. It's high gross margin. And when I go and if I talk to, I don't know, a friend at GC or Sequoia or IVP or pick any like firm, just kind of catch up and say hi. Like such a point that sticks really, really well is like, yep, they've raised $7 million, just left 4 million in the bank, and they're at like 5 million of ARR, and they're like tripling. Like that's great, because that also gives comfort to the VC firm, the new VC firm, that like if I gave them more money, they'll continue to be kind of capital efficient in the right ways. So no one really likes a frivolous spender too. So yeah, like
General other life advice.
yeah, more general life advice. I mean, like a low cumulative burn multiple is it's just a good thing. And I mean, there's some exceptions if you're an open source company. We don't invest in open source. I mean, there's generally pre-revenue until Series A or Series B anyways. But yeah, like if one of your companies has burned 10 million bucks to get to 2 million of ARR and they aren't open source, 90% of the time that company is probably dead in the water, and they'll need to recap anyway. So it's important.
Yeah. And so we just kind of talked about this as far as like collecting metrics from companies. But Preface is asking for things like cash metrics and stuff like that. And how often are you asking for companies to share that information with you?
Quarterly is totally sufficient. Like in a dream world, you have API to Plaid and this, that, whatever, like maybe, but probably not. like if it's you want numbers to be sort of cleansed and aggregated, and like quarterly is perfectly sufficient.
Yeah, and we see 70% of investors send a quarterly requests through Visible as opposed to maybe monthly or semi-annual. So quarterly is definitely the norm to kind of get those updates from founders. So next benchmark that we're going to look at is actually percentage of portfolio led by tier 1 VCs at Series A. I think this is an interesting one to talk about because I know a lot of investors I see kind of like maybe tout that they co-invest alongside tier 1 VCs. Excellent to do that, but just kind of like how there's kind of, compelling data when it's actually the follow-on round that a tier 1 VC participated in. And so Preface has been around for about 10 years. Would be curious to hear how you guys have kind of built relationships with tier 1 VCs, and what does a company have to demonstrate for you to be able to make an intro to a tier 1 VC?
Sure. Yeah, this is a really important point. I know like a lot of like GPs will showcase that they co-invest with Sequoia or like General Catalyst, and by the way, these are really good firms, and I'm happy that they exist. Um, if you look according to AngelList data, when a multi-stage firm invests in seed, it actually shows a neutral to negative correlation in raising a successful Series A, which is defined as like a 3x markup. There's like signaling risks to it. That's probably the most like common piece of it.
Mm-hmm.
Again, but that math really does change at the Series A. So like according to one very famous fund of funds, who I won't disclose who it is, if one of Sequoia, Excel, Benchmark, or Greylock invested in your Series A, the likelihood of a home run is a 4x. And by the way, the term even tier one VC, it's subjective, right? But like according to this fund of fund, that was sort of tier one: Sequoia, Excel, Benchmark, or Greylock. And yeah, I mean I will push. I mean, I know one thing actually will even tell founders when they do have those conversations during a seed round, they should ask the GP like, hey, like, what percentage of, if you invested in my company, what percentage of the total fund is it? And if they
Yeah.
say like a percent, and then you can ask questions. I always tell founders to do this too, like, how many boards are you on? Or what were the last 4 investments you did, and what stage were they? Like all
Mm-hmm.
these things are really important. I mean, it's like you're selling, but then you become a customer really fast with a VC firm, depending on the process of sort of diligence. And so, yeah, I don't know. There's just avoid it. I avoid it completely. And even there's a small class of LPs who think like I can't get into Sequoia or X firm, and therefore I'm going to use this firm as like kind of like a proxy
Mm-hmm.
to have kind of exposure. Like, not interesting. I mean, like I don't know. It's those those folks are usually not the most sophisticated, and they probably won't be in the asset class for very long.
Mm-hmm. Yeah.
Oh, sorry, to answer your question, I forgot to ask. So, um, making like good relationships with sort of tier one VCs. Yeah, I'm grateful to say that I could probably text one GP at every multi-stage firm who will like respond to me and be like, fine, I'll meet your company tomorrow. The way to do it is to tell the truth always. Always, always, always. Like, don't BS anyone, just tell the truth. Be a human being first, like see how they are in their sort of careers, understand investments that they've done recently, be well researched.
Mm-hmm.
And like I'd say, when I do make that kind of introduction, it's usually there's usually some soft marketing that I do, where
Mm-hmm.
I'll maybe like text them like, hey, like this thing is really starting to take off, or I might actually include a subset of important GPs that I'm close to that might actually be LPs in Preface. We don't take fund money, but we take individual GP money sometimes from people that
Mm-hmm.
we're close to. That helps too.
Okay. Makes sense. Some good advice there. And we actually had two people ask after we mentioned tier one VCs, just kind of how is, tier one VC defined? We already kind of said that maybe, it's ambiguous a little bit. How many firms are on the tier one list? Who are they? Kind of already spoke to this, but anything you would add when, people say tier one VC, what should people be thinking about or who?
Yeah, I mean, I would say like that list shouldn't be longer than like 7, maybe. And I would say like look at companies that actually have exited, like have IPOs from the early stage, and like a consistency of it.
Mm-hmm.
And like when you think about the history and how young venture capital is as an asset class, there aren't that many.
Yeah.
There aren't that many. Like, you can look at performance and you can kind of see and you can kind of hear through whether it's through common LPs. Like I know like the performance of certain funds, like, whoa, like if maybe they're not tier one right now, but they will be if they do that one more time. Um,
Mm-hmm.
yeah.
Yeah. Excellent. All right. And then this is going to be the last one that we kind of do a deeper dive into this section. And actually, when I was preparing for this webinar, I actually didn't include these metrics in there. And then Farooq said, this is actually important. I want to talk about this. So this is all has to do with blended ownership, winner reserves, post Series A. And so why did you stop me and say, hey, I actually want to talk about this. This is important. And maybe we'll just start there.
Super important. So people want to, like, if an LP will ask for a fund model, they'll ask for a fund model typically because they want to know your entry to reserve ratio. But are you as a GP good at like being able to put more dollars to work in like your excellent companies? And so a different, very famous fund of funds actually like had a 3-to-1 ratio as like for all their home runs, 10x plus returns. in their sort of top kind of performing companies. That's just it's smart kind of money management and fund management. All these three are kind of related. So the blended entry cost, people ask about entry ownership a lot.
Mhm.
LPs do, but they don't talk about post Series A ownership. And if like, are you smart? I mean, if you most GPs, and this is true kind of quantitatively, like if they just wrote the same check most of the time and didn't do any follow on, like their fund will sort of perform higher. But a lot of us on the call, we do for many, many reasons. We wanted to kind of put more money to work in companies. But
Mhm.
the blended sort of entry cost specifically in 2020, 2021, 2022, like gosh, I've seen so many people like logo buying, like they'll put in 100K again into a company, and then someone like, I don't know, Index will give 30 million at 150, and there might even be room for $1 million check, but like gosh, when you look at an average VC backed exit of like 150 million bucks, it's pretty hard to like, that's not interesting. Like that's not an
Mhm.
interesting return on a blended basis. And so um, we try to keep our blended entry cost sub 30 million. So even with a little bit of dilution, with a $150 million exit, which is life-changing for a
Mhm.
founder, that's still like a 4x. And I think a 4x generally is accretive to like, we want to, with a small fund, we hope, and we have done this before, like getting above sort of like 4x. That's sort of what we tell people. The
Mhm.
only way you can do that is if you have like kind of consistency of approach. And then lastly, having higher ownership in your winning positions, let's say your top 10% companies. So let's say in the top 10% of Preface companies, our average ownership is like 5% or 6%. And then the average across the whole portfolio is like 4%. That's a good thing. It just shows that we're able to put money and ownership in the companies that we define as good. And
Mhm.
again, there's a real there's an implication that the GP knows which companies are good. Hopefully they do. That's kind of our job. But yeah, I would say this one's pretty critical. And let's say an LP of yours asks like, oh, have you heard about this fund? They've gotten follow-ons from so and so and so and so and so and so. Like, oh, like that's really great. That's wonderful. And honestly, having a good follow-on ratio is super strong. But one thing that I care about a lot is we have a really low blended entry cost. And
Mhm.
we have actually had also a handful of really good sort of Series A follow-ons from good firms. So like being able to sort of counteract like the fluff kind of shine of it all, I think is really
Mhm.
critical.
Yeah, yeah. Excellent. I think in interest of time, we're going to keep going to the last part of the webinar, but just so you guys know, these metrics are all talked about in depth in that article that Preface Ventures that kind of kicked this whole thing off a few months ago. So we'll share that in the follow-up, but these are some other metrics that were mentioned in the napkin. So for benchmarking fund performance at year 4, so early recycling, tail ratio, TV, PI, and DPI. So we'll follow up with the article so you can learn more.
Yeah,
Final
just
part.
just quick, I would say one thing. Recycling is a good thing. Like if you're good at investing, you should have more shots on goal. So if you have a couple of like quick wins, most funds that are like top 1 percentile, they have like 100 and I think it's like 107% on average of like deployed capital. But yeah, for the other two pieces, they're pretty self-explanatory on the article. But feel free, Farooq at prefaceventures.com if you guys have any questions.
Love it. All right. So we've been talking about these benchmarks, which at the start we set the context of these are useful for GPs for reflection, can be useful to kind of impress LPs and kind of just know this data proactively to share with LPs. Could also be used for fundraising if that's where you're at in your stage. But just some questions for preface about how you're actually communicating with LPs. How often are you sending updates to LPs? Could be just general updates about fund performance to your current LPs.
So we update them every quarter. We update them every quarter. We also send over SPV performances that twice per year, also via Visible. I feel like GPs do a terrible job at updating LPs and SPVs they may have brought to the table.
Mhm.
Yeah, and again, we use Visible and we have kind of tear sheets for each of our portfolio companies. On the like kind of napkin, like these type of metrics and sort of graduation rates, like we always sort of kind of calculate that stuff. But I'd say like we'll put it together like every, I don't know, twice a year, even for myself. And then also too, when companies haven't succeeded, it's an opportunity for me as a GP to reflect like, oh shoot, like that thing didn't graduate. Was it because I was wrong about the market, or the founder had a health issue or something, which is like, act of God and out of control. Like
Mhm.
I need to have that like a frequency. And the benchmarks are shared with, for sure, the kind of Napkin benchmarks are shared with potential LPs and current LPs.
Mhm.
Current LPs, if you're subscribed to a fund, you can, and you probably won't see this in the slide that Bell you're about to show, but like we'll irate the company by excellent, average, good, or sort of performing well. And if
Mhm.
you're not an LP into the funds, you can just see the order of the companies. And if you
Okay.
are LP into a specific fund, you can click it and get a one pager like the one that you're showing,
Mhm.
which shows, investment date, when we invested, total investment, blended MOIC, what the holding valuation is, run rate, gender diversity, which is important to me and us as a firm, runway, outlook. Um, yeah. And it's good. Again, I genuinely can say that LPs, one of the things that LPs remember about Preface is like the quality of reporting, and we look good because Visible helps us.
Shout out to Visible. Thanks for that. But yeah,
Yeah.
this is actually the tear sheet that Preface actually uses. And yeah, you were just talking about kind of the status here and kind of how you rank your company. So that's included in every tear sheet, which can just be a really quick indicator to LPs on how this company is doing. And then just calling out a few like key metrics as well. And then when it comes to these tear sheets, how often are you sharing these tear sheets with LPs?
Yeah, it all happens quarterly, and quarterly is sufficient. I mean, most LPs just want to like. It's actually, shout out to a C level exec at Capital One, who's one of our LPs, who basically said like, look, like love all the detail. I'd love for you just to rank the companies and then tell me like which ones are drivers. I'm like, okay,
Mhm.
that makes total sense. And then we just took that feedback and implemented it here, and it works.
Yeah, yeah. I've heard that from a few other VCs. I know everyone's like, not everyone is doing this. I know we've actually had Lacey, who is on this webinar from 01 Advisors, join us, but they also do like kind of similar rankings. So it's a great idea to do that and make it quick and easy for your LPs. People have like different ways of defining kind of the health status, but it is something best practice. LPs like it. It makes it easier for them. So just some insight there. All right, so now we're coming up to final minutes. I know a few questions have come in while we've been discussing, and we've addressed a few of those. If you have more questions, feel free to write into the chat right now. So a question came in from Claudio. I think that this is interesting to address. So this is talking about confidential data with portfolio companies. So in your LP report and kind of tear sheets, how do you think about, founder confidentiality? Are you telling your founders that like this is going to be shared with LPs? And yeah, how does Preface think about that?
Yeah. So from the start of our quarterly reports in general, when we kind of write the email and it goes out via Visible, we say like, please keep everything confidential. We do set the expectations at the beginning, like, hey, like every quarter we're gonna ask for 5 things, and this will go out to LPs along with some commentary. And I'll usually say things like, hey, like a lot of them are C-level execs of public companies, like we have a bunch, and so they could be customers, and that's usually sufficient.
Mhm.
Yeah, it's usually sufficient.
Yeah. And something I would just add, I think everything you mentioned is great. I've also seen investors within the request within Visible include in the detail, right? So we're asking you for these 5 metrics and maybe a qualitative update. They actually call out like this information or this qualitative information is going to be a part of our LP reporting. And then a separate box that says like confidential information that you just want like Preface to know. So right, so company, and then it kind of instills this trust with companies of like, I know that Preface is sharing this with LPs, but I actually just want Farooq to know this, and just kind of calling it out, and so founders know and just have that expectation that Preface needs this for LP reporting, and they know they're sharing that. So another question that I saw come in is, sorry, there's a few different ones. Okay, I think I'll do this one over here. So, because I know Farouk, you actually had some maybe individual investments before kicking off your institutional fund. So Matt wrote in and just said like thoughts on emerging managers pitching on angel investment performance, and does that track record matter?
It matters. It definitely matters for sure. I mean, like that is where you have probably truest attribution. Usually when people are in venture or maybe they're at larger institutional firms, they have to sort of share that with other people or share the kind of like credit for it. Um,
Mm-hmm.
like we did have actually like an official entity with third party capital, and we did have to report, and that it was small, but it was still like a fund.
Mm-hmm.
Yeah, I mean, call it fund zero or fund one. I think that's usually like enough, and be upfront about it and be like, hey, like this is our pilot fund, but our pilot fund's been really, really strong. So
Yeah.
yeah, for sure use it, and hopefully get like a handful of your founders to be wildly positive references for you.
Yes. Yeah, I love that. And we actually did a webinar with Recast Capital all about like emerging managers and fundraising, kind of like how to build your track record, and think like having that angel track record is excellent and can be like the best and maybe only way to start, just so LPs have something to reference. So definitely think that it matters. And so yeah, I think the response there was great. And actually we are all up on time.
Hey,
Farouk,
can
really
can I
enjoyed.
share one thing real quick?
Oh yeah,
I feel
yeah.
like one person on my team who's actually on the call is Tony. I know like Tony and you have interfaced before. She does a really wonderful job with all of our reporting, and I just wanted to give her a shout out. So thank you, Tony.
I love that. I meant to shout her out as well. Yeah, she's been excellent to work with for the past few years, as Preface has been customers of Visible. And yes, just really enjoyed the conversation. Thanks so much for your time and for your insight. We'll be following up with the recording, Farouk's article that he published. And if you guys have any other questions, do you want to say your email, I think one more time, or how people can get in touch with you if they have questions?
Yeah, it's Farooq, my first name, Farooq at prefaceventures.com.
Excellent. All right. Thanks everyone for joining.
Thank you. Take care. Okay. Good luck.